So our first speaker is Gary Maher from Castle Trust Bank, a very, very important lender to us, as I've mentioned. He will be speaking today about their buy-to-let product, and as you can see the word exclusive on there. And guess what? Because we do so much business with them, that's what we have. That's why it's got all our marketing material on there. A little bit about, and that was sent to you, by the way, about 9:45. So just check your email or your spam. You should have an email from us with all the details. So a little bit about Gary. Gary has predominantly operated in the finance sector throughout his career to date. Before joining Castle Trust Bank, he worked as a business manager in a BMW dealership for 8 years. He gained promotion from telephone business development manager to business development manager within 12 months of joining Castle Trust Bank, and has now been with them for almost 2 years. And here's the slide he's not expecting. His claim to fame is Gary's younger brother, Ronan, recently played in the FA Cup for Walsall versus Leicester City. So that is your brother, I hope, because that's what I Googled.
It is him. As you can see, he obviously got the good looks as well.
I was going to say, well, he got the talent, you got the looks, Gary, but I'm very kind. So Gary, it's over to you. I'll come back in about 20 minutes. So you are still quite dark, but don't worry about it. If you come close to the camera, I think you'll be fine. I'll see you in about 20 minutes. People, enjoy.
Wonderful. Thank you very much, Tony, for the lovely introduction there. And thank you all for joining us this morning. I'm glad to see that despite my picture being attached to all the marketing, that it's a record number of attendees. So yeah, very, very positive and great to hear. So I'm going to give you a rundown of Castle Trust's current buy-to-let offering. I won't take obviously too much of your time and go into too much depth. I just want to give you a flavour for sort of hotspots and that we are seeing, and just give you an overview of the current buy-to-let offering. So by the end of the presentation, what I aim to do is to create for you an understanding of where Castle Trust now sits in the marketplace, to understand what we can do, and importantly, what we can offer and what we can't offer. I think it's very important. Obviously, everyone is time. There's never enough time, is there? But so it's important that you know what we can and what we can't offer and do to assist you and your clients. To highlight some key hotspots for that we are seeing success in, and essentially just make sure that Castle Trust is in your mind when that case lands on your desk. You want Castle Trust to be on your radar to think, okay, maybe Castle Trust can help and assist with clients and lead to them or help them to achieve their goals. I want to demonstrate obviously different options for you and your clients, and obviously just to highlight some recent changes to our policy, just for those who may be familiar with Castle Trust already, but just obviously to highlight those areas where there's been some developments. So, Castle Trust. We are a buy-to-let specialist lender. So what is important is just to highlight what we lend on in terms of securities and who we lend to. So in terms of what we lend on as a buy-to-let lender, we lend on residential securities only. So we don't do commercial or semi-commercial, but see standard buy-to-lets, holiday lets, multi-unit freehold blocks, HMOs, large portfolios, and also a little bit of development exits and bridge to let. Who do we lend to? I do apologise, I think there was a part missing to this slide, but who do we lend to? So foreign nationals, expats, well, certainly we would consider. First-time buyers and first-time lenders, first-time landlords, sorry, would certainly be considered, and we would consider that really our bread and butter. But limited companies, complex limited companies as well, based in the UK or abroad, we can consider. So there's quite a broad range of potential clients that we will consider. But certainly the first time buyer piece, as long as they are buying in a limited company or SPV, they can certainly consider that. Interestingly, we don't have a minimum income requirement We just require there to be an income, but no minimum income requirement, which sets us apart to other lenders when considering first-time buyers, that we don't have that need. So some key points to our criteria, as it's important, just to highlighting obviously what we can and what we can't do. So all of our products are available to all types of customers. So we don't differentiate. And as you'll see a little later in the presentation, we have it's quite a straightforward product, easy to understand and easy to put that into whatever security you have. It will fit and onto our buy-to-let offering. So as I mentioned, first-time buyers and landlords, and first-time buyers, landlords or investors are accepted and considered. Foreign nationals and expats. We lend on properties in England and Wales only. It's not because Scotland and Northern Ireland aren't lovely parts of the world. I think there is legislation is a little different north of the border. So it's not something that we lend upon currently, but things may develop as Castle Trust is developing all the time, certainly with our offering. But currently, it's England and Wales only in terms of locations that we will lend upon. When looking at multi-unit blocks, we do have a minimum size requirement, 4 units. What we need to see is an average of 35 square metres. Can consider units down to 30, and if we're being completely honest, if we're looking at 27, 28, 29, probably going to be able to get comfortable with it. What we are keen to get across is that we are agile and we can think, in a bespoke fashion to try and make the deal work. Look at obviously the positives, and if that means that we need to bend the rules, but in terms of our lending criteria, be a little bit lenient to gain comfort and make something work, then we certainly will do. But what we do look for an average of 35 square metres where possible. We will consider limited adverse credit by referral. So yes, I would certainly suggest if you have that client that the credit history is a little bit checkered, shall we say. It's not a straight no. We will do all we can, and with every case we try and look at the positives to get comfortable and to move forward there. Our minimum loan size is £200,000. So 200,000, and on the buy-to-let up to 2 million would be the maximum lend. As I mentioned, we will look at every case sort of individually on its merits, and do our best to get as comfortable as we can with moving forward. So what I wanted to, as I mentioned earlier, is just to highlight some key hotspots where we're seeing a lot of success recently. So holiday lets would certainly be one of those hotspots. So we've had a very busy period since the turn of the year with holiday lets lending on our term 10 product. So when with lending on holiday lets, we lend based on the holiday let income, so not an AST income. So as you can imagine, that's often considerably higher than higher income than your standard AST. So we will ask for 2 independent valuations in terms of the annual income, and we will look at a high, medium, and low numbers, take an average of them obviously between the two, but certainly we would base the lend on holiday let income. We'll consider limited companies on holiday lets. Importantly, we would also consider first-time investors or first-time buyers. So that's definitely an area where we are seeing a lot of traction with first-time buyers. As long as they are buying in a limited company or SPV, then we can certainly consider them. We offer term and bridge options. Obviously, we're going to focus on the term side of things here. Residential property, and something that's key to bear in mind is that when lending on a holiday let security, it must be free of any restrictions. So as long as the property can be put on an AST, if need be, then we're good to go. Expats and foreign nationals are considered. I mean, so they're living abroad. Obviously, What we may find with foreign nationals, as I'm sure you'd be aware and would probably expect, is dependent on the level of risk associated with either the nationality or the country of residence. There might be some enhanced due diligence that needs to take place, but it wouldn't stop us from considering them in any way, shape or form. The other important thing to bear in mind with holiday lets is the sort of plausibility. So would you go on holiday there? What we want to see is the location to be in keeping with a holiday let. So location wise, pretty much anything on the south coast or near areas of natural beauty. Wales in general seems to be quite a significant portion of our holiday let cases are coming into us. It seemed to be in Wales, but I'll give an example, which is not to cast any aspersions on anyone that might live there or be fond of the place. But if you have a holiday let case coming into us, but the property is in Slough, for example, probably not going to work in terms of the location. Just the plausibility. Would you go on holiday there is a question that we would ask you to take a view on. So just to give an example of sort of the flexibility and agility that we're trying to impart and the service that we give. Just get an example here of a case that came into us. It's a holiday let in Canterbury. As you'll be able to see in the image there, it's a top floor flat above a Prezzo restaurant. So straight away you're thinking, well, it's above a commercial, maybe it's not the ideal security. Holiday let on the high street, maybe not ideal. So the broker had two options in place from various lenders. One lender offered 64% LTV due to them only using the AST rental income for ICR calculation. The other lender, who remain unnamed, but the other lender offered 60% loan to value, which used a holiday let income, but they restricted that LTV due to the asset, obviously being above a commercial, and go from there to the comfort with the asset. What we were able to do, and we're able to do this quite quickly, because although we are a bank, the way that we are structured, we have quite a flat hierarchy. So in terms of from myself up to sort of the MD, everyone is available and can be available very swiftly. So we're able to get all the important people onto a call to discuss particular cases fairly swiftly, to be able to come back to you as a broker with an answer. Obviously the best answer is always yes, we can do that. But in my opinion, the second best answer would be a quick no, we can't for this reason, to allow you to obviously get on and service your client, who at the end of the day, that's who you're there to look after. But because of that meeting, we were able to look at the bigger picture, review the asset and the area, use the holiday let income, get comfortable with the security because of the location and obviously the income there. And we were able to offer 75% LTV on there. So a lot higher by being agile and looking at the bigger picture, get able to achieve a higher LTV than other lenders were able to. We're also seeing a lot of business, a lot of cases coming into us regards multi-unit blocks, multi-unit freehold blocks. So we do have quite a significant increase in inquiries and cases coming into us on multi-unit blocks. But just to give you an example, we've recently completed on a case for a 4-unit multi-unit freehold block. We've also recently completed on a 67-unit block. So there is quite a range and that where we consider there. So certainly with a larger number of units, certainly something that we would consider and look to get comfortable with. We will consider first-time landlords and investors, obviously foreign nationals and expats. Going back to, as I said, this is where the unit size is important. We would like to see that average overall unit size of 35 square metres. We will consider units in the block down to 30 square metres, but comfortable. We want to be comfortable with obviously 35 square meters as the average. Look at a bespoke valuation. Now we will value based on aggregate value on units up to 20. So up to 20 units, we will take a view and we will do aggregate valuation there. We can look at, obviously, as I mentioned, bespoke transaction structure and bespoke pricing if need be. If we're looking at it's complicated, complex cases, we can be agile and come up with a bespoke solution for your clients. So our max loan is 15 million. Now this is by, obviously, would need to be signed off for the people a lot more important than myself. But our maximum exposure per client would be 15 million. But obviously on the buy to let per case, we're looking at 2 million on a standard product. If there's anything over 2 million, then we can look to bespoke that. And see, Tony and the girls will certainly be able to assist you with that. So in preparation, obviously, takeaways from today, what I wanted to impart was that for your holiday let cases, to think Castle Trust, multi-unit freehold blocks, to think Castle Trust. HMOs is another area where we were seeing a lot of success. We will consider obviously the larger HMOs, usually up to 6 bed, but if we're again over 6 bed into like the sort of sui generis realm, then yeah, we will certainly consider that by all means. First time buyers and first time landlords, expats. Basically, what we want to impart is that with your buy to let cases, we want to be on your radar. We're here to assist. And what is key for us is we want to provide a good service. So the service that we are providing, we want it to be top notch. So you then think, okay, we've had a great experience with Castle Trust. We want to come back again. Yes, obviously, thank you very much for your time. We appreciate it. I think I'm pretty much bang on there, Tony. I think we've got some time for some questions.
Well, we've got a remarkable amount of questions so far, which is great. So I'll read them out one at a time. Huda said, will you accept an SPV owned by a holding company UK based?
Yes, we will. We would certainly consider it. We would need to obviously do due diligence in terms of overall owner, etc. But yes, we certainly would. We do have many cases of complex limited company structures. So yeah, we would certainly consider that.
Okay, Kartika said, do you lend to ex-council local authority? I presume that's ex-council local authority, or do you lend on ex-council local authority properties?
We will. What we want to see, and what we would be concerned is the wrong term, but what we would want to see is that the surrounding area, we'd like it to be over 50% privately owned. So if it's ex-council, that's something we can get comfortable with. But what we want to see is that surrounding area, over 50%, we'd prefer it to be privately owned. But what I will say is obviously we do have lending criteria, as everyone does. We do try and be as agile as we can. And if we can gain comfort in any case, because of the security or the client profile, etc., then we certainly will look to do that. And
remember, it's my job to always try and bend it as much as possible.
Very aware of that, Tony, yes.
Yes. Who said, what about foreign residents? I think you've already covered that, actually, that you're lent to foreign nationals. So
yeah, certainly.
Yeah, which isn't an issue, as we've done many times. Michael Ashcroft, hello Michael, long time no speak, has said, do you accept more than one property per application? Aldermore allow this? You can answer that, or I can. But one of our case examples I'm going to give a little bit later, we did an advance per castle last year, 19 properties on one loan. So certainly will. It's something they will do where necessary.
I think we will both remember that case forevermore, Tony.
So will I. I will be talking about it later. I actually have to scroll down here. There's been so many questions. Marie has asked, holiday let, does this include short-term let to contractors, Airbnb, etc.?
We will consider Airbnb, yes. This is probably, I mentioned Slough, is what the location. But if we can build, if we have Airbnb, for example, and this is the best example I could give. I don't want to go I always relate everything back to football, but we lent recently on it was an Airbnb in Manchester. Now, it happened to be available and let typically for people going to the football, to going to Old Trafford in Manchester, around the corner and using the Airbnb to stay over. So we will consider Airbnb. We'd like to see some history and like forward bookings, etc., and do a bit of due diligence on that front. But yes, we will consider them and look to get comfortable where we can.
Okay, sorry, I'm losing this. Been so many. Marie, again, it's our second question. What is the maximum age at application and term?
So the maximum age would be 75. Application. So 75 would be the maximum age.
That's for the youngest borrower, though, isn't it? So if you get we had one father and son last year. The father was 82, 88, maybe even older. The son was
again. That probably would just tie into look into every case on its merits. And so there are criteria there, but if we need to be agile and think outside of the box and gain comfort, then we certainly will do.
And delegates, they're that agile that we did actually, they'll also be discussing this one later. We did complete a very large advance with them last year for an 86-year-old and an 82-year-old. So again, like I say, my job is to bend things, but put things across so they go, yeah, we really want to lend in that circumstance, regardless of the fact it's outside criteria. Kartika has said, what are your stress rental calculations?
So stress rental calculations, so security-wise, HMOs and holiday lets would be stressed at 145% ICR. That is the only specific to security ICR calculation. Limited companies and low-rate taxpayers would be 125%. High-rate taxpayers would fall into the 145 bracket. So it's either 125 or 145, dependent on security and client circumstance.
Okay, and Kartik's then second question was, is top slicing permitted?
It's not something that we are overly keen on currently, I think, due to the current sort of market conditions. Again, what we would want to see is that before we consider or even consider top slicing, we want to see a significant portion of affordability in terms of where are we hurdling on the ICR. So if we were at a higher percentage on a limited company, we're looking at 125%. If we were up to 115, 120%, but falling a little bit short, that's where we might consider and try and get comfortable with a top slice. But ultimately, is it something that we're going out and saying, yes, we definitely do? No, it isn't at the moment. But again, just adds to the sort of bespoke nature that if we have to try and get comfortable with the case, then we certainly will do.
Okay. Julian has asked, what is your limit on HMO in terms of rooms?
So limits, we would consider, we have cases of 10, for example. Typically, what we would see is up to 6 beds would be the hot spot for the cases that we see, but we will certainly consider larger ones. We in terms of obviously room wise, we don't really like to see more than one kitchen in the security. So that's probably going to dictate how many rooms we would look at. But I wouldn't say it'd be open-ended. As long as the security is ticking the boxes in terms of comfort for us, then we would certainly look to get comfortable and look to give a solution on it.
Okay, and then Mike has asked, can you do consumer buy-to-let?
We do not currently. We operate unregulated space is what we're currently operating in. What I will say is that Castle Trust are continually developing. We are growing both. We look to grow both inorganically and organically. And as you grow, obviously your product portfolio develops. So it is something that is on the horizon that we'd be looking to step into that space. But currently, just certainly it'd be the unregulated space that we're operating in.
Okay, Alison's got quite a long question actually. CML handbook states that the lender requires 2 months advance notice before forfeiture action is taken, and the lease only provides for 28 days. This is a scenario I have for a buy-to-let remortgage. Is this something that you would allow for a buy-to-let?
We would. So obviously we were looking at ASTs. We require an exit clause, 6-month exit clause. So it's pretty standard on the AST contracts. I would like, if I'm honest, would like to see, and I keep harking back to, but it's something that we would take a view on and look to get comfortable with. So as long as if that is a quirk to a case, but the security stacks up, the client profile stacks up, can we take a view on it? We'll certainly consider it by all means.
Okay, well, I'd probably say on that, Alison, it's one of those where the people behind Castle Trust, the people I certainly deal with, have got as much experience in the business as I have, and they're all from a lending background. They've been doing it a long, long time, and they know a good deal when they see it. So it's one of those that we would have a discussion with them, and if we can get them comfortable, it's something they will do. Some of the stuff that Castle Trust have agreed certainly over the past 18 months for us, I probably couldn't get through anywhere else, because you're not dealing with the same level of experience at some lenders. You're dealing with underwriters, maybe I'm only been doing it 2 years, whereas I'm dealing Barry, the MD of Castle Trust, has been doing it since I don't want to say how old he is actually, but a long time. Yeah, a long time. So it's a conversation I'd have with him, or the sales director, Anna, who's also been doing it a long time. Helen has said, what are you like with payday loans with a clear credit history?
It's not ideal. It's not something we wouldn't be saying, yes, please have payday loans on there. We would require a little bit of investigation and probably with some background as to why it was taken advantage of. The rest of the credit file is strong. It's obviously going to work in the client's favour, but it is again one of those, not ideal, but can we be comfortable? Does everything else stack up and give us a reason to want to do it? We're very keen to look at every case positively in terms of why should we do the case, not why shouldn't we.
I can't remember the last time I saw a payday loan on a credit search, to be honest. It's been a long
time.
No,
I agree. It's been
some of the high-cost lenders, they're doing longer-term stuff these days, but I really can't remember the last time we saw one. But Amy's asked, Airbnb, does this include serviced accommodation?
Yes, it does.
It does. Marie, final question, because we're, again, bang on time. My client has suddenly had a £6,000 default put on from an energy company which took over one that went under. They cannot provide any proof or bill, and this was for a property that was rented out. Although my client owned, would you take a view on this? The energy company cannot provide any proof.
Again, this is going to be just giving the same answer here, but we would take a view. We would like to see it satisfied. It certainly would fall outside of our lending criteria, but does everything else, such as the rest of the credit file, stack up? Do we have what's the background story as to why this happened, etc.? Is it plausible? Does it make sense? We put it in front of the right people. Are they comfortable? So we certainly consider it by all means.
Okay, Marie just said it. Otherwise, immaculate credit history, and it isn't their debt. So I'd probably say, Marie, that's one that I would, if we can maybe speak a little bit later on today, give us some more detail, along with obviously the other information on where the property is, what the value is, etc., what the client wants, and I'll have a conversation. I don't go above Gary's head. Gary tends to deal with my staff. My contacts are obviously MD, sales director, etc., and Gary, as and when we need to speak, which we do a little bit later, by the way, because that other deals are now goer. But it's one that I wouldn't probably trouble Gary with it, because he's then got to take it to somebody else and he's too busy. So I'd just speak to somebody and say, this is the circumstances, and we try and work a solution. And that's the advantage of Castle Trust, because you don't get that at their main four competitors. You're not speaking with people at the same level most of the time. You're speaking with people who've not been doing a job long enough to make a decision, and it's criteria says no situation. Or computer says no. Okay, that's the most questions we've ever had for a speaker in all the time we've been doing these. So thank you everyone for those questions. Gary, thank you very much indeed. I will speak to you about 1:05 this afternoon. Hopefully, if you're in, which I'm sure definitely. You are. Thanks for the presentation, great, covered lots, answered lots of questions. and I'm sure we're going to see a few Castle Trust inquiries coming our way very, very soon. So, Gary, let Simon take you out of it, take you out of the meeting. Don't close it down yourself. While you watch the whole thing down, because you do have that power. And we will just now wait for our next speaker.
Wonderful. Thank you, Tony, and thank you, everyone else, for your time.
Thank you. This is Marie Grundy from West One. I always call her Marie Kennedy, which is her maiden name. That's how long I've known her. But I have known Marie a long time. And she is our managing director that's speaking today. This is the quality of people we get to our shows. And so a little bit, first of all, you should have received this via email again about 8:45 this morning. If you signed up afterwards, it would have come to you afterwards. It's their West One Loans second charge mortgage range, dated 16th of September. A little bit about Marie. Marie joined West One in 2017 and is currently the managing director. I thought the way we use the word currently, is that a good thing, or another promotion? Or
hopefully for a while, yeah.
Oh, good. Okay. Well, she is the managing director of the second charge and residential division, which launched fairly recently, overseeing loan origination, sales management, distribution, and product development. Marie has worked within the mortgage market for over 25 years, starting out as a graduate trainee at the Yorkshire Building Society. Prior to joining West One, Marie was managing director of a specialist distributor, V-Loans. She's one of our competitors, giving her a unique insight into the market from both the perspective of broking and lending. Marie has also held senior positions within the specialist lending market over the last 17 years and was appointed to the board of the Society of Mortgage Professionals in 2019. Is that the one that I voted for you? Or was that another one?
That was Amy.
That was the Association of Mortgage Intermediaries,
yes,
okay?
When was at V-Loans, yes.
So, but she knows her stuff. She was working quite a senior level at one lender, which I won't mention because it was a 2007 lender. She might not want me to mention, so, but it's Sutton Pacific Mortgages. Okay, so Marie doesn't know this, but what we've done, as we've already discovered, oh yes, Marie. Marie once, this is her claim to fame, she once appeared in a Bryan Adams video, but for some reason they seem to have more camera time for Oscar and BAFTA award-winning actress Rachel Weisz. I did watch the entire video yesterday. I believe it was from the video. Was it for There Will Never Be Another Tonight?
Yes, it was.
There you go. I did watch the entire video, expecting a Courtney Cox in a Bruce Springsteen type situation where you would be like ushered to the front and get on stage. That was the only still I could find. I can't even see you there.
Yeah, you need to freeze frame it. I'm on for about a second.
Right, okay. I've never watched a video that has so many different camera shots in 4 minutes. There must have been about 200 different camera shots. So actually seeing anything was very difficult. But if any of you want to see Marie in action at Bryan Adams in the Bryan Adams video, that's what you need to do. Right, Marie, over to you. Your 20 minutes for your 23 slides starts now. No pressure.
I'm off. And so obviously, thank you very much for your time. We've got a lot to get through because I want to cover off 2 products that we offer currently. So really what I want to talk about is the economic outlook for 2023, how that's going to impact on borrowers, particularly with a focus on affordability, what I see as the growth drivers for the specialist mortgage market in 2023, and also look at second charges. I do believe that this is going to be a really strong year for second charges and just want to go over some of the reasons for that. So for those of you that haven't come across West One Loans, we are an award-winning provider of specialist mortgages and property finance. We're part of the Emma Specialist Finance Group. So our product range encompasses pretty much everything you can think of within the specialist lending market. We're one of the largest bridging lenders in the UK. We offer development finance, buy-to-let mortgages, second charges, and we launched into the residential mortgage market only in October. So one of the newest entrants into the owner-occupied market as well, which obviously I want to talk to you about. We're the fastest growing non-bank lender in the UK, and we were recently acquired by Elliott Advisors, who's one of the largest hedge funds in the US. They were the backers of Charter Courts. They've got deep experience in the specialist lending market. But for us and for you as intermediaries, what that really means is we are very well capitalized and we've got lots of diversity in our funding lines. So that's obviously important, particularly at this moment in time. And it's really important to mention that every single one of our products can be accessed via specialist financial services. There's not many packages that have access to the entire West One product range, especially with residential mortgages being very new. So Tony and the team are very well versed in West One and how we operate, and obviously the relationship goes back over many years. In terms of the economic outlook for borrowers, I think it's very clear to anybody operating in financial services that this year is going to be challenging for anyone involved in the mortgage world. Inflation, as we know, has been escalating, which hasn't been matched by wage growth, although there is some more positive news around inflation coming out of the news in the last week or two. Obviously, we're moving into sort of a regime of higher taxes. We've got a weakened labour market. Everything is pointing to the fact that we'll go into a recession in 2023. How deep and how long that will be remains to be seen. But actually, I think with the rate of unemployment, I think there is some optimism that the recession will not be as deep as maybe was first thought. But obviously, that will remain to be seen. There's also a concern around house prices. So we're also already seeing sort of lower property transactions. You've got landlords who potentially are looking to sell off properties because of the pressures in making rental yields work. All of these factors obviously have an impact, along with borrowers' ability to borrow at the same rate that they have been in a higher interest rate market. So there's lots of factors that are going to mean that borrowers are going to find it more challenging to actually meet their financial aspirations. I think in particular, the biggest impact is going to be on affordability. And there's quite a few stats here, and I'll just, pick a few out for you. But ultimately, there's around 1.4 million borrowers who will face a payment shock when they renew their mortgage during the course of 2023. And in fact, the ONS predict that around 57% of those borrowers have an interest rate fixed under 2%. So when you're looking at the doubling or potentially even higher multiples of that interest rate, borrowers are going to find it a tough time, either just to meet their existing commitments, or if they're looking obviously to purchase a new property. So some challenges coming down the track certainly this year with respect to that. ONS also reported that 4 in 10 borrowers were very or somewhat worried about the changes to the mortgage interest rates. Obviously, the media like to promote bad news, and I think that really, just escalates that fear factor amongst borrowers. So it's our job really as intermediaries to help borrowers navigate these challenges. And there's lots of work and things that we can do to help borrowers in this situation. So I think, like I've just mentioned, that there are going to be more borrowers than ever that are going to need the intervention of specialist advice and professional advice from mortgage intermediaries. So I guess you guys are going to be very busy right now. We're seeing increased demand for debt consolidation. I think that's going to be more prevalent, particularly as borrowers are looking at ways that they can reduce the commitments on a monthly basis to increase the disposable income to offset some of the payment shock that they may be experiencing when they come to refinance. There's also the likelihood that there's going to be a deterioration of credit scores. More borrowers, they're going to have credit blips. I know Pepper did a study quite recently that showed nearly 8 million borrowers have had some form of adverse credit in the last 3 years. And we all know that sometimes the smallest blip can exclude them from mainstream lending, which is where, again, specialist lenders like ourselves will be there to help borrowers who might otherwise be excluded from high street finance. Self-employed borrowers always seem to get the rough end of the wedge, and I know Mortgage Broker Tool reported in their that they have an affordability assessment system, and they reported that the affordability for self-employed is at its lowest since 2020. So again, more challenging for self-employed borrowers looking to take a mortgage out. And for those particularly with complex or multiple income streams, sometimes it does take a more individual approach to underwriting to assess a a borrower's picture and really understand how their income is made up and how that can work to be sustainable over the period of the mortgage. So certainly specialist lenders are very well set out for that. So in terms of borrowers that can benefit from specialist mortgages, we've talked about the self-employed, perhaps those with shorter trading histories, those with multiple income sources. It's tax bill time. We're seeing an increase in applications for borrowers who need help in meeting tax liabilities, and those with more fluctuating income or non-standard sources of income, such as contractors. Also older borrowers. So I feel that there's a big gap in the market for borrowers sort of in that over 50s age range who may well be pushed down the later life route when it's not entirely suitable. So I think there's more that we can do as lenders to be innovative around products for that set of borrowers. We're seeing a higher percentage of purchase mortgage applications at the moment, and a big proportion of those are first-time buyers. So I think they're one group of borrowers who would benefit from a decline in house prices. So it's something that we're very mindful of. We're already working behind the scenes to develop some quite innovative criteria to really try and support first-time buyers who need help in getting onto the housing ladder. So there's certainly good demand and strong demand for first-time buyers. And then, like I mentioned, those borrowers who may never have had any issues with their credit history before, but now are starting to experience some credit blips just as the cost of living really impacts on household income. And so we, like I said, launched our residential mortgage product range through a limited number of partners, of which Specialist Financial Services were one. We only launched in October. So we've got lots of plans to really expand our residential mortgage product range. But we've got a range of products that cater for borrowers in what we call our Prime Plus range. So maybe they just fall outside of High Street. And then we have our prime and near prime plans that allow borrowers to cascade through our products depending on the level of adverse or depending on how long you've been self-employed for, as an example. So we've got lifetime trackers, 2 and 5 year fixed rate options. Our lifetime trackers don't carry any ERC, so it gives additional flexibility while borrowers test out what's going to happen to interest rates. As you know, we're now starting to see swap rates come down and fixed rates are coming down with it. So the picture looks a little bit more positive. We have LTVs up to 85%, and that includes first-time buyers. And it also includes capital raising for any legal purpose, including debt consolidation. As standard, we talked about affordability. We recently increased our standard LTI across all our plans to 5 times income, and that's with a minimum income of 15,000. So that gives additional flexibility for borrowers who are looking for a slightly higher LTI to help them with their mortgage application. But we also have another product, part of our Prime Plus and our Prime range, which is called the Flex product. And that allows LTIs above 5 times income, where the borrowers have a minimum household income of 50,000. That's available up to 75%. And again, just gives you additional options that you might not necessarily have with the existing lenders that you deal with. Again, quite a popular product to just help borrowers who need that additional flexibility there. And we've also got a fast track remortgage service. So coming from a second charge lending background, we've actually picked off some of the things that work really well for us from a second charge perspective. And when we were doing the research as part of the launch, one thing that came through loud and clear was the pain that can be experienced in that post-offer period. So some of the brokers we're speaking to said, you know, getting to offer stage isn't necessarily an issue. Getting it completed is a nightmare, particularly when you're looking at a free legal deal where you're in a queue with a large panel conveyancer. So our solicitors are based in our office. They sit behind us, our team of underwriters in our office. We are their only client. And basically the fast track remortgage service means that we're doing all the legal work. Usually that's done by the point the offer's issued. And then once the customer returns the mortgage deed, we can actually complete it on the same day. So if we've got all the relevant redemption figures and undertakings, they're all in date, we've got everything we need, we can do same day completions. So our average completion time with this service right now is 2 days from the offer being issued. And the feedback that we've got from that has been excellent. So that's something, you know, if you need somebody who really needs to raise funds and get that loan through quickly, this is a great service and quite innovative. And we've got interest only options as well for higher earners, up to 75% LTV. So again, giving you extra possibilities with that LTV. It's a minimum loan of 100,000, and we have sort of higher income thresholds for the interest only loan of 50,000 for a sole borrower and 75,000 for joint borrowers, providing one of the borrowers earns at least 50,000. And we offer loan sizes up to £1 million as standard, but we can consider loans up to £1.5 million by referral. So we are a lender that can offer flexibility if it doesn't quite fit criteria. We have a broker support team who are very helpful and will work through any inquiries that Tony and his team have, who will obviously know our criteria inside out. So we can work with Tony and the team to see if there's any flexibility for strong referrals on cases as well. We don't operate a credit scoring system. Everything is a credit assessment, and our affordability is also automated, which gives certainty at the point of sale in terms of the decisioning process. And it's a very simple calculation based on household composition. We can do AVMs for smaller remortgage cases up to 150,000. And we can do loan terms up to 40 years with a maximum age of 85 at the end of the term. One thing to be mindful of as well is that we don't take into account satisfied CCJs and defaults for plan assessment purposes. And we also disregard any unsatisfied CCJs and defaults under 500. Same for unsecured credit with balances under 500. And also public utilities and common suppliers. So that will give you additional options that you may well again not have, because what we want to try and do is bring something new to the market rather than offer the same as everybody else. That would be pointless. So again, just gives you some flexibility for borrowers who might have had some more serious or more recent issues. We can also look at borrowers who've got missed payments and unsecured credit. And we can also repay current IVAs and DMPs on our near prime plan, but we can also look to help borrowers who've had recent IVAs and DMPs if they cleared over 2 years ago on our prime plan, and that's up to 85% LTV. So turning to second charges, it's an industry I've worked in for many years, and I think this year all the macroeconomic environment that we're seeing is really going to support and drive growth in the second charge market. I've never had so many brokers who've not necessarily been very active in the second charge market come to me and say, look, how can I support this market? How do I write more business? So last year we saw a 45% uplift in the second charge market. It increased to 1.5 billion, still tiny in terms of the overall mortgage market, but I would expect that figure to increase closer to 2 billion during the course of 2023. And last year was the biggest year for second charge lending since 2008. So obviously debt consolidation is quite a big part of the second charge market. It's an alternative to remortgaging, more so now because we're in a rising interest rate environment. So whereas before it might have been better for the borrower to refinance onto a rate sub 2%, now obviously we're in a different world. And I think for many borrowers who are also in long-term fixed rates, who have ERCs, or particularly for borrowers who are going to be forced down the product transfer route, because from an affordability perspective, there will be no options for remortgaging, then all these borrowers who need additional finance will find that second charges is a real viable alternative for them. So that's some of the reasons we expect second charges to grow during the course of 2023. Touching on the product transfer market, I think the expectation is that's going to account for around £212 billion worth of lending according to UK Finance. And there will be 1.8 million borrowers reach the end of their fixed rate maturity during 2023. So like I've mentioned, affordability constraints, maybe changing credit profiles as well, are likely to fuel the demand for product transfers, and additional borrowing can be met by a second charge. Again, just useful to be aware of that. So second charges, it can really help mitigate against the effects of the current economic climate. Again, like I say, where debt consolidation, when I say the word specialist, we're very experienced in assessing debt consolidation. I think it's becoming a more specialist area of advice. So that's something to be bear in mind in terms of how you access these products. All of our second charge products are only available through master broker partners such as Tony and his team. And there's a reason for that, is because it works very well from both the processing and advice perspective as well. So there's much more potential for better customer outcomes. It gives you a wider scope of service to help you retain client bank, and also it's a move towards a more holistic advice approach instead of just being very narrow in terms of that advice piece. So I think from a second charge perspective, there's flexibility in terms of the term and the loan purpose. So we'll do loans up to $500,000, but we can consider bigger loans on referral. We also do an interest only second charge, again targeted at high net worth borrowers who need a loan size of 100,000 and above. But there are very few interest only products within the second charge market, and that's really targeted at borrowers who want to do some high-end home improvement projects or buy second properties, as an example. So we've seen some nice deals come through on that basis. 80% of the borrowers that we lend behind actually are high street borrowers. So we're not seeing borrowers come to us because they don't have other options. They're coming to us because it's the best possible product for them, given their current situation, particularly if they want to protect a low interest rate mortgage or they have an interest only mortgage as well. So here's an example of an interest only borrower who's got 300,000 outstanding, and I'm sure you've come across lenders who may have a borrower with an interest only mortgage, but when they come to raise a further advance, they make it conditional that all of the borrowing is flipped onto a repayment mortgage. And this is that sort of example where currently you've got a borrower paying £437.50 a month. They want 50,000 for home improvements, but to do that, it's going to cost them £1,000 a month just to borrow the extra money, because again, they've got to convert the whole borrowing onto a repayment mortgage. Whereas by leaving the mortgage in place on an interest only, taking the additional 50,000 out on a second charge, even at a rate of 7.5%, that would actually save them £600 a month. So that's a really good example of where we see second charges being a good option and the right outcome for borrowers in that instance. We also offer buy-to-let second charges. Again, it's a product that's not generally available through most second charge lenders, and that really helps landlords who are looking potentially to make improvements to their existing portfolio to increase the rental yield or value. It might be so they can extend their portfolio of properties, take advantage of obviously some of the falling property prices, but also for personal use. So landlords can use it to raise money for their own purposes, again, home improvements to their own property, debt consolidation, or other reasons. So again, quite a useful product to have in your armoury, particularly if you deal with landlords. So in terms of sort of the advice and the submission route for second charges and for our first charge product, you can access all of that through Tony and the specialist finance team. Like I said, I think there's going to be so many opportunities for brokers to really take advantage of the options that specialist mortgage providers such as West One and others provide. And obviously, if you've got any questions or you need to refer any cases, Tony and his team will be extremely helpful in assisting you with those. So that's me rattling through it, Tony. Hope I've managed to not go over time this time.
Almost there. I've just had something pop up on my screen from iCloud saying, telling me what my storage is, and I don't want it, and it wouldn't disappear, so it covered my whole screen. So Marie, breathe. Excellent, thank you. Absolutely brilliant as always. We are actually still within time, so all is good. So we have one question at the moment from delegates. Parminder has asked, for the Prime Plus Flex and Prime Flex mortgages, do you use income from land and property? If yes, how much do you use as a percentage?
Yeah, so we would accept income from land and property throughout our whole range, including the flex products. So we would treat it as self-employed income. So we would ask for, we work off SA 302s. We don't ask for accountants' references. So we'd ask for the last couple of years SA 302s and tax year overviews. We'll deduct any sort of mortgage payments from the SA 302 if they have been bought within that tax period. If obviously they've acquired other properties since then, we wouldn't take those mortgages into account because we're not using the income from those properties. So yes, we can, in short, use income from land and property, and we can use up to 100% of that after we've deducted the mortgage payments from the income.
Fabulous. We've got time for one of your own questions. I did miss the start of it because I needed a toilet break. So if you've already answered this, forgive me. But as a new entrant into the mortgage market, what are you seeing in terms of the drivers for borrowers seeking out specialist mortgage products?
Yeah, we're seeing quite a diverse range of reasons. So we've got some borrowers that are coming to us because they've had one-off life events. I think we had one the other day where they've been through quite a messy divorce and it had impacted on their credit history. They've now met, a new partner and want to buy their first house together. So that's a good example. We also had one actually where it was a very credit-worthy borrower who I think they were also sort of in their 50s. They had an interest-only mortgage with a high street, and they'd come to the end of the term and they wouldn't extend the interest-only mortgage. And because her income was good income, it was around 68,000. But because on the high street, as you know, you're looking at a minimum sort of 100k to get an interest-only mortgage. So that was one where they were able to refinance, keep their payments within an affordable range for them, and they had a really strong sort of solid exit of downsizing in the future. So that was another one. And like I mentioned, we're seeing quite a lot of demand from first-time buyers, and that's an area of the market that we are really sort of interested in supporting more. So what I would say is, like I said, we're new to the market. We've launched our first version of this product, but in the same way that we've done with other products in our business, the feedback that we get from you and Tony and others will continue to evolve our proposition. And we're already working on some quite major criteria enhancements in the background for our residential mortgage range. So definitely watch this space, keep an eye on updates from Tony. But we are hoping to really sort of bring products to help underserved borrowers in the market, and first-time buyers are a big part of that for us.
Excellent. Marie, that's wonderful. I won't ask the second question because you've already answered that. So we've got no more questions. You are bang on time.
Yes.
So, well done, Mrs. Grundy.
It's a well first, right?
Fabulous. Absolutely fabulous. I was going to go out for breakfast while she was talking, but I don't need to. Right, people. Marie, thank you very much. Simon will remove you from the room. I'll speak to you very soon. Hope to catch up soon.
Take care,
will. So our next speaker, Jonathan Prince, Allica Bank. You should have received this morning via email about 8:45 or afterwards if you signed up after 8:45. But that will be in your inbox. So have a look at that. A little bit of a bio on Jonathan. He's been working in commercial finance for the last 10 years, all of which have been spent with small challenger banks. He has largely worked in credit functions, giving him a strong understanding of business risk, and moved into relationship management at the start of 2020. And his claim to fame, and again, this was only because he didn't give us the name of the person behind this. Jonathan's great-grandfather was the pioneer of the way we now make socks, but of course he didn't give me his name, so I couldn't get a picture of his great-grandfather, if there was one on Google, in one piece rather than a separate heel to toe. I Googled that and just got a type of sock that I'll call heel to toe. So I just got a picture of an old sock. I think I've probably got one of those in one of my drawers at home somewhere that looks pretty much like that. But Jonathan, over to you. I'll see you in 20 minutes.
Thanks, Tony. What I'm going to talk through today is, rather than a usual sort of talking through a product offering, I thought I'd use this session to talk a little bit about commercial mortgages, including things like how to assess a commercial mortgage, what a good application looks like, and how to put together an application to give it the best chance of getting through a commercial lender's credit team. Any questions, obviously, we will cover at the end. So just to touch a little bit on Allica, we've been in the market for over 3 years now, and we were founded with the sole purpose of giving established SMEs the business banking that they deserve. So as it says there, our aim is to make us, or misspelt aim, is for our customers to make us the UK's most recommended business bank. And we're, I'd say, a very short way through our journey to that. But the goal for the bank is in time to be able to provide any credit facility that a UK trading SME would need, and also any savings, current account and payments functionality as well. So I wanted to start off by how an underwriter or a bank will assess a commercial loan. And one of the most famous acronyms that we use for this is Campari. I dare say this probably created in the 80s over a Campari, but it's nothing to do with the alcoholic drink. It's just a nice little acronym that we use to assess the key factors in a loan application. So starting with the C, character. Character is the most important thing to us as a lender, and that is essentially that borrowers, how they conduct their business, their attitude to credit, and basically it's what makes that individual tick. If somebody's got the wrong character, you can have the best proposition in the world, but they choose not to pay you back, and you don't get any income from the loan. So it's always at the top of any acronym, and there's lots of different acronyms out there in the commercial lending world, but character tends to be the top of pretty much all of them. Now, because we are largely broker introduced, obviously we don't meet every customer. For our larger transactions, we will, but for smaller things, we're reliant on things like reviews of their business. We're reliant on their credit score to tell us, and their credit record to tell us their attitude to credit that they've had in the past, and other publicly available sources of information, such as simple Google searches and that sort of thing. Ability is the ability of the individual or individuals within that business to make that business a success, to keep it running profitably, and ultimately to continue that business running through the life of our loan, to ensure that we get repaid. Means is the financial means both of the business. So if it's a limited company or a partnership, that is their balance sheet strength, their income, and it's also the means of the individual behind it. So if you've got an investment transaction with a single tenant, at the end of that lease, there might be 6-7 months until they find a new tenant. That's just a normal part of the commercial mortgage property cycle. But has the individual behind that deal got the means to be able to cover loan repayments in the meantime? Have they got cash that they could release from other investments, other income that they could use to support, and basically give us that extra sort of second safety net on the repayment of the loan. Purpose is as simple as what is the purpose of our lending. So if we focus on commercial mortgages, typically the main purposes that we see are somebody looking to acquire a new property. So that could be an owner-occupier trading business looking to either buy the premises they currently run. They might be going through an expansion period and need a little bit more space to trade from. Or it could be a commercial property investor looking to add another property to their portfolio. In terms of purpose, what we're looking for really there is that it makes sense to the customer. It makes sense to us, and of course it's a legal purpose for borrowing. So when I say make sense, things that don't make sense, for example, if a borrower was looking for a cash flow facility, so for example a wholesale business looking to buy some stock, Borrowing by way of a commercial mortgage over 25 years probably isn't the most sensible way for them to obtain that money, because there's specific shorter term cash flow solutions for that. Amount is essentially, are we lending enough? Are we lending too much? It's not necessarily just a proxy of loan to value, but things like, are we lending enough for the borrower to fully achieve their plans? So things like, have they taken into account stamp duty and legal fees and the costs of the transaction in their borrowing request? I.e., have they worked out that I've got a £50,000 deposit, so therefore I need the rest as a mortgage? Or if they had that thought of actually, I need 5,000 or 6,000 to cover the fees involved in the transaction. Repayment comes quite far down the list, but I'd say is probably up there in terms of important factors when assessing an application. But repayment is quite simply how is that facility going to get repaid? So what is the ongoing source of income? So whether that's the rental income from an investment property, whether it's the trading profits from a business that the borrower is running. And then we look at secondary repayment options. So has the borrower got other properties in the background or assets in the background that if the primary source of repayment failed, so if the business became less profitable or the tenant stopped paying rent or vacated the property, is there a secondary source of repayment there? And then lastly, insurance. This is essentially the security that's available for the loan. So for us, commercial property forms the primary form of security, and we'll go a little bit into what makes a good commercial property a little bit later on. But what we'd also look at here is, are there other forms of security that make sense? So for example, if we've got a business that is a lot of their assets come from money that is owed to them by their customers, it might make sense for us to take a debenture over their business, for us to basically have a charge and have control over some of that income that's coming into their business. Or if there's a specific risk that we need to mitigate, we could be looking at things like personal guarantees from other businesses, or other forms of security. So like I say, there's lots of these acronyms out there, but Campari is probably the most common, and it really does walk you through not only how to assess an application, but things to think about when you're putting together an application for a lender. So affordability and adjusted EBITDA, this is something that every commercial lender that lends to a business will consider, regardless of whether they're lending on property, whether they're lending on assets, or whether they're lending on an unsecured cash flow basis. An adjusted EBITDA is basically a calculation that a lender will undertake based on the business's accounts to understand what money is available to repay the loan that's being considered. So EBITDA is another acronym. We love our acronyms in commercial finance, which stands for earnings before interest, tax, depreciation, and amortization. And then most lenders will make further adjustments to it. Now, what I've done here is I've set out the way we at Allica add and deduct to get to an adjusted EBITDA. Each lender will have their own slight variations on this, but the basics remain the same across all commercial lenders. So why do we use adjusted EBITDA? The reason for it is a net profit of a business won't tell you the whole story in terms of the funds that they've got available to service a loan, or actually even the cash that business generates. So if we take depreciation and amortization as an example here, they are both accounting transactions essentially. No money moves out or in of the business because of depreciation or amortization. It's simply a way of that business accounting for costs that they've had in previous accounting years. So the adjusted EBITDA calculation tries to get us to what are the actual pounds and pence available that business has to service the loan. So the things that we adjust for here, we add back the IT DNA, so that's the interest, the tax, and the depreciation and amortization. We will then also add back any rent that's being replaced. So for example, you've got your local corner shop that's been renting their premises for the last 10 years and they're looking to buy it. Clearly, they're not going to be paying that rent anymore once they own it. So that can be added back. And also, whilst we're on the topic of rent, additional rents received. So say, for example, that corner shop has a flat above the shop. Previously, their landlord was getting the rental income from that. But on completion of the purchase, your customer's going to get that rental income. We can add that in as well. And then we add back any one-off costs. So this is an extraordinary cost that the business has faced in any particular financial year. So for example, if they bought a property in the previous year, they might have had additional professional fees that we can add back. They might have launched a new product within their business a couple of years ago and undertaken some external consultancy on that. And you know, lots of different one-offs, but your customer will usually be able to advise you any one-off costs that they've had in their business the last few years. And finally, a loss on an asset sale, and we have a profit on an asset sale on the other side. This is, for example, the business has a van, they bought a new one and they sold their old one, and they either made a lot of profit on that. Clearly, that's a bit of a one-off. It's not going to happen every year, so we would add that back in. And then in terms of what we then deduct, so we deduct any dividends or drawings that are taken from the business. So this is money that the directors and shareholders can take from the business after the net profit. Now, sometimes they'll be taking more out than they need, and we can make a sensible assumption on what's the required amount. But typically, if somebody's been taking a figure for 4 or 5 years, they will need to continue taking that amount out to support their lifestyle. Capital expenditure. So this is something that's not shown in the profit and loss of a business, but this is purchases of assets that business might need year on year. So if you take a business like, for example, a haulage company, they will quite often need to purchase new vehicles or equipment throughout the year, year on year, to keep that business running smoothly, and that will need to be taken into account. Again, one-off income. So something we're seeing a lot of recently, the last couple of years, is grant funding for businesses. Now, some businesses were genuinely impacted by the effects of the pandemic and did see reductions in turnover and profits. But some businesses, particularly things like convenience stores, were able to continue trading all the way throughout, didn't have any impact, but were still able to claim government grants. We would see those as surplus income, and obviously very much one-off, so we would deduct those. Other lender repayments. So this is any finance that the business has that is not going to be cleared by the proposed loan. So say a business might have some hire purchase finance or something like that. We would need to deduct the payments due under that facility. And then the last thing is energy cost stress testing. So as we know, costs for businesses and individuals for light and heat have increased significantly over the last few months. Now, we take a different approach depending on how recent the most up-to-date set of accounts we have is, but we're deducting anything up to 2 times their cost to reflect the effects of rising gas and electricity prices. So what does good look like? So in terms of the borrower, we are looking for somebody that is experienced in their field, has a proven track record of success. So that could be through running the business that we're looking at lending to. That could be through previous businesses that they've run and can demonstrate the evidence there. We're looking for financial strength that allows them to support their business. So this is what I was talking about earlier about secondary sources of income, backup ways of servicing that debt, really add to the strength of a deal. And the credit history of the borrower and the business finances. And what we're looking for there is that borrower has the right attitude towards borrowing money they've honoured their payments on previous loan facilities and all that sort of thing. Now, in terms of the property, this one can be much more subjective. Now, we do engage the opinions of professional RICS property surveyors, but that tends to come later down the process once the mortgage has been approved. So the things that we're looking at during our initial assessment and when we're underwriting a deal are a couple of key factors. So the first being location, and now slightly tongue-in-cheek pictures here. But out of these two, I think you'd agree that one is probably going to see much more pass-in traffic than the other. And we're looking for things like, does that business location make sense for the business? So a high street makes perfect sense for a retailer, probably less sense for a manufacturer or haulage firm, whereas equally, that out-of-town industrial unit again would suit the haulage firm much better than the retailer. So does it make sense for the kind of business that is being carried on there? And the second key factor that we assess is condition. So regardless of whether we're looking at an investment transaction or an owner-occupier transaction, one of the things we think about is demand for that property, whether that be from a tenant or from a purchaser in the event of needing to sell the property. Clearly, the better condition a property is in, the more prospective buyers that it's going to have, more prospective tenants it's going to have, and generally there's going to be a much higher demand for that property. So lastly, I just wanted to cover some tips for a successful application. So when you're putting together an application for a lender, whether that's us or anybody else, try and think about the things that I've covered in the last sort of 15 minutes and remember that you know your customer and the lender doesn't. So if you knew nothing about that case, would the application that you've put together explain all of those different factors to the lender? Would they understand your customer? Would they understand their business? Would they understand how we're getting repaid and the financials of it? Have you explained the strengths and weaknesses of the application? And if there are any weaknesses, so maybe the property is a little bit more remote or the business had a year of less strong financial performance, have you understood why and explained why to the lender to mitigate that risk? If you've made any adjustments to the finances, so what we were talking about earlier, particularly in regard to one-off costs and one-off income, have you explained those to the lender so that they can take them into account in their calculation as well? And the last thing I would say is, if in doubt, include it. Lenders will find pretty much everything that a customer might want to hide. So if a customer makes you aware of any information at all, then please do include that in the application.
Jonathan, brilliant. Thank you very much indeed. I've been spending the last 15 minutes trying to think of the Campari advert in the 1970s. I'm old enough to remember that. I think it was it Lorraine Chase? I think it might have been. Can't remember now. And the Rustum. No, that was Cinzano, wasn't it?
I can't help on that one, I'm afraid.
I'm sure it was Lorraine Chase, if anyone remembers that. Right, okay, we've not got any questions other than Michael's very kindly told his time as a lending banker during the 1970s. There was the acronym paper chimps, which means purpose, amount, period, exchange, control, repayment, character, importance, performance, profitability, and security. Wow. Okay. As I joined the bank in 1979 and was sorting 3,000 checks a day into alphabetical order, I didn't come across any paper chimps. I could probably come up with an acronym for what I did, but it would probably be quite rude. Marie's actually confirmed, yes. Luton Airport, yes, it was. Right. So no questions from delegates, although someone is typing. We are just about at time, actually, so I'll be very quick. What are the benefits of manual underwriting?
So manual underwriting gives us the ability to understand a case. When you try and use any automated system or anything like that, it can't make the adjustments that we've talked through. It can't take into account the strength of an individual behind a transaction or the strength of a property. It's all based on data. And as we know, lending is a very human thing that just can't be replaced by computers.
And computers can't enjoy a Campari.
Exactly.
At all. I've no idea. I've really got to say, well, I mean, that was excellent. I always say to my staff that when a lender accepts a case, that is the peak of their interest in that case. things can normally only go one way, which is downwards. So submitting everything, warts and all, right at the start, and not trying to hide anything is absolutely imperative, because of course a lender's going to find out if there's something that's, it will come out of the woodwork eventually. I mean, what you don't want to do, you find it out after 2 months. Lender finds out after 2 months and declines the case. So getting that peak of interest right at the start with everything, warts and all, and if the warts can be explained away, then that's the job. That's certainly our job here, to get the cases approved on day one. Very interesting stat that I got just before Christmas is that one of my staff is currently completing 36% of cases that she actually receives. So 100 cases she gets, she completes 36% of them. That's 36 out of 100, which is pretty damn good. It's because we do present cases in such a way that we can then argue a case. If the case is borderline, it's better to let the lender know it's borderline right at the start, rather than just drip feed information where their interest is just going to drop and drop and drop, and eventually they'll decline it. Selwyn has just asked, this will be the last question we have. So Selwyn has asked, so your bank is seeking clients that want bank finance for the respective business?
Absolutely, yeah. So we, outside of commercial mortgages, we offer asset finance and growth finance, which is a cash flow loan. But on the commercial property side, we very much are pretty much exactly 50-50 split across commercial investors and owner-occupiers trading businesses with their own property.
Okay, I will speak to you after we finish today, because we have a client looking for $1.25 million for asset and growth finance, who I think you might be quite interested in. So I know it's not your bag, but you can put me in touch with somebody whose bag it is. So, absolutely. Right, Jonathan, thank you very much. As always, absolutely brilliant. Sorry about the picture of the sock at the beginning. Maybe next time give me your great granddad's name.
I'll give you more information.
But we'll see you again soon, hopefully. And Simon will take you out of the room.
Fantastic.
Okay, cheers. Here we have Sherice from Tuscan Capital. A little bit of her background. Also, sorry, first of all, this is what we sent you earlier on. This is their current criteria or product guide. Should have had that this morning. And a little bit about Sherice. With over 10 years of experience in bridging finance, Sherice is a seasoned sales manager with a passion for all things property. She has a proven track record of success working for first-class lenders, where she developed a deep understanding of the bridging loan market and honed her skills in relationship building and business development. Sherice's expertise and drive for success has enabled her to consistently deliver outstanding results. She is a motivated and enthusiastic professional who is committed to providing top-notch service to her clients. In her spare time, Sherice enjoys spending time with her family and engaging in outdoor activities. And her interest in fact, which I was her claim to fame, I must get that right. It's full habit, unfortunately. Very, very impressed with this. Sherice is the great-great-granddaughter of Jim Peerless Driscoll, a Welsh boxer and British featherweight champion who won the coveted Lonsdale belt in 1910. And there is a picture of him. And I thought it was one of these things where you just try and Google it and something might come up. This guy's got statues up in cities, all sorts. So not only was he obviously good at what he did, he was incredibly famous around the time as well. So that's a picture of Sherice's great-granddad. There you go. The wonders of Google, eh? Right, over to you, Sherice. I'll see you in about 20 minutes-ish. Good luck.
Thank you. Good afternoon, everyone, and thank you for joining us. Thank you to Tony and the team for having me today. As I said, this is my first time doing this, so I'm really nervous, I'm not going to lie. My name is Sherice, and I'm here to introduce you to Tuscan Capital. We're the leading provider of fast-track bridging loans designed to help you and your clients overcome short-term financial difficulties and achieve their goals quickly. A little bit about Tuscan. We joined the market about 5 years ago now, and our ultimate goal is to provide common sense, fast bridging loans, mainly bridging loans that are user-friendly. As I'm sure you're all aware, application processes and getting the deals through underwriting processes can be a struggle. And lots of lenders are averse to complex and, quite frankly, quirky deals, which tend to slow the process down for completion greatly. Our mission is to provide flexible and innovative financial solutions for your clients. This could be for property developers, investors, foreign nationals and buy-to-let landlords. We understand the importance of speed and reliability in securing your funding. One thing we pride ourselves on is acceptable customer and packager services for yourselves and for your clients, and are committed to providing our introducers with the best possible experience, which is why we work closely with Tony and the Speciaist finance team, as they understand it's about quality. Our fast-track bridging loan service is second to none, with credit-approved terms within just 4 hours, and our team of experts will help you along the way. We offer unregulated bridging loans up to 70% LTV with interest rates starting at 5.3 over base rate, and our fast-track product offers LTVs up to 70% with a maximum loan of 10 million. We also offer search indemnity, title insurance, and no personal guarantees up to 65%, just to shorten the process. And our terms are available from 3 months to 24 months, so quite the short-term loan. Loan sizes start at a minimum of 100,000, and we go up to 10 million, as I mentioned. But it's the fast track product that we are most excited about, and this is what I'm here to talk to you about today. We found that a lot of transactions were taking a really long time, customers becoming frustrated, brokers becoming frustrated. And after listening to the feedback that we got, we did extensive research on our packagers, introducers, and lending partners, developed a fast track option as a solution to that problem. It provides added confidence and peace of mind when time is of the essence, and overall saves customers on all important upfront costs. We have been able to complete transactions in as little as 7 days using this product. It's one of our most used products at this time, and our fast track products are ideal for a variety of purposes. We use them for auction purchases, renovations, debt exits, refinancing, and bridging the gaps between selling and one investment property and buying another. This product is one of our favorites because it provides quick access to funds, usually in a matter of days, so your clients can take advantage of the opportunities when they rise. Alternatively, we can use our desktop option, which is perfect for a quick and simple solution where AVMs aren't possible. We can go up to loan to value using a desktop using a desktop report of up to 70%. When looking at these types of assets we lend on, looking at the types of assets we lend on, we provide residential, semi-commercial, and commercial assets. Our HMO funding is also available up to 75% of the vacant possession value, which is usually utilized for purchases. Our commercial borrowing options have a maximum of 65% loan to value and a maximum loan of 1 to 5 million. We can do multiple assets and cross transactions as well. So if you have a portfolio of commercial, semi-commercial, and residential assets, we can usually average out the LTVs to accommodate those. We have completed commercial deals at a much higher amount as well when secured over a large portfolio. So we can be flexible. Where was I? As you have heard, we have offered a variety of funding types for acquisition, auction purchases, refinance, and equity release, like refurb and dev exit portfolios and HMOs. Using our AVMs, you can save time and you can save time considered for credit approval with title insurance and search indemnity to avoid delays. We operate across England and Wales with regional sales managers covering all corners from London, Manchester and Birmingham, and offer a wide range of valuers and solicitors who know our process well and can work through our streamlined legal requirements very quickly to ensure a smooth transaction. When it comes to the deal itself, we take each case on its own merit. So adverse credit and CCJs are considered, as we understand that the idea of a bridging loan is to repair and build wealth. So now I'm going to take you through, if I can find it, our product guides, so you can have a little closer look at what we can do. Oh, okay, so it's already flipped. So yeah, a variable base starts from 5.3 on residential fast track offering, and it goes up to 0.67 over base. Another thing that we look for in terms of our criteria is 24 months. We start at 100,000 to 10 million, as I said. Mixed use properties acceptable. We can look at loans that are undervalued purchases as well, up to 85% loan to purchase. We can do private individuals, corporates, SPVs, etc. Foreign nationals are also accepted. We have no exit fees or early redemption penalties. What else was I looking at? Sorry. So another thing I'd like to highlight in the fast track product is their credit approved terms within 4 hours. So as long as we've got the relevant information on the application, we can get you those terms within 4 hours, which means we then activate the AVM in the same day and instruct legals in the same day. So it all happens within 1 day. Everything gets going, and it is a smooth process. We usually get the AVMs back within 24 hours as well. So we know where we stand from there and we can proceed with the underwriting process. Title insurance, as I said, and search indemnity are accepted. No PGs required up to 65% LTV, and legal documents can be executed remotely, which means we can have foreign nationals in a completely different country and still complete the loan. In terms of exit strategies, we don't ask for much. We just ask, what are they doing? If it's refinance, is that logical? Will they looking at their credit report? Will they be able to structure that? And if not, what can we do to help? We do have lots of things in place in terms of refinances and things like that will be able to assist. Funding types for our residential fast track offering are usually auction purchases, purchases, refinances. We can do cross charges for second charges as well, using a full valuation. Development exits, buy-to-let portfolios, etc., etc. Moving on then to the next slide. This will be our refurbishment and commercial offering. We do drawdowns. We can do as many drawdowns as you want. It just depends on the cost of works. Again, up to 10 million. We can go up to 65% day one value and 65% of GDV, started at 0.79 over base. Again, for our refurbishment loans, we do offer for private individuals and corporate entities, foreign nationals. We can offer for HMO refurbishments as well. When I take you over to the case studies, I'll be able to tell you a little bit more about how they work. But our requirements for fast track refurbishments are pretty simple: full address, full purchase price, cost of works as well, GDV, the planning status of the loans, etc., and the experience of the borrower. Hopefully we can have a little look at their assets and liabilities and previous experience, and then we should be able to get comfortable with that. Commercial loans, we go up to 65% LTV, and we start at 0.79 again. We can look at all sorts of commercial loans in terms of assets as well. We do shops, retail. We have a load of self-storage and industrial units at the moment, things that are being converted from industrial into normal commercial or residentials, things like that. And yeah, we tend to do a lot of cross charges as well when it comes to our commercial loans. So across portfolios, we've done a fair few large loans over a portfolio of commercial assets. This first case study here is to demonstrate our development exit bridges. So this first one here was quite a big one from Bucks. It was Allica, 18 flats and 4 houses, and he was repaying a development lender. The only thing is he'd run out of time and he needed it really, really quickly. We managed to get that one done. I think the completion date on that one was around 4 to 5 weeks. This one in Borough was another one, repaying an existing facility, but also raising some funds to finish the works. I'm sure you've come across quite a few of them, although they're fizzling out at the moment, but we had a lot of clients who had run out of funds, or lenders completely pulled on their bridging on the development loans during COVID, couldn't get the works done, etc., etc. So a lot of borrowers have taken to refinancing using bridging loans to get the works complete. This is one of those. It was done really, really quickly, and yeah, it enabled the client to finish the project, with sale being the exit. So we were quite confident with that one. And the next one in Huddersfield was refinancing of another facility, which was allowing the client to raise a little bit more money to finish off finishing touches to the property. It was at PC level, but he needed to put some last minute touches onto the property and had just run out of money. So we were able to develop that. It was quite the big development though. It was 19 units, and the exit was sale of 4 of the units. So yeah, we managed to get comfortable on that one. It was quite difficult because it was quite a high yield, but still we managed to do it. So there's that one, and then moving over to the purchase, and I'm sorry, I can't see half of my slide. Moving over to the purchase and refurbishment bridges, we have sorry, bear with me. Yeah, sorry, we have our I think this is one of our fast track projects again, funding for an extension on a mixed use property. Former offices and second floor was developed. Sorry, the second floors were developed into 12 flats and 2 commercial units below. We managed to complete that one, I think, in a matter of 4 weeks. So that was quite a quick one. This one was quite a large one and quite a difficult one, as it was cross loan over a couple of residential assets that the clients owned, albeit it was done in a completely different name. So the acquisition of the flats were done in a company name, and the residentials were in the borrower's in a private name, so individual name. Then moving on to the next slide. These are our fast track highlights. So these are the ones that we've completed in matter of days. Fairly straightforward assets and borrowers basically, but the client needed this one. The funder had pulled out. He had a matter of days to complete, and the notice had already been issued. We managed to get a slight extension on it, used an AVM and completed within 19 days. This one here was an unencumbered property that required an equity release for an onward purchase. The borrower was portfolio investor and experienced borrower, so he needed the funds really, really quickly to move to secure a purchase. Short form was used on this one because it was fairly large asset, and we completed that within 11 days. Then I just wanted to highlight our average loans, which are usually between 715 and 750. Average LTV on these kind of assets, fast track processes at 60%, although as I mentioned, we do go up to 70 using AVMs. Average valuation size, so average property values coming in at 1.1, and our average term is 12 months, but as I said, we go up to 24 and do as little as 3. Moving on, these are just more of our fast track case studies. This was a particularly quick one where the lender had pulled out again on an auction purchase, didn't have long to complete. He was already halfway through the deal. We agreed the loan on the purchase price as it was quite a lot lower, so we went 65% LTV, 85% of the purchase price. And completed the loan within 14 days using a AVM. And then Virginia Water, this was a £2.1 million purchase at 70% LTV. Client was close to losing the deposit. Can't remember what happened on this. Oh yeah, it was an overseas buyer, and he didn't quite meet right criteria with a buy-to-let lender. We used a full valuation due to the value of the property. But due to the valuers that we use, we managed to get it done within a very quick time frame. We also continued using the current valuation that they had, which was done by one of our panel surveyors as well. So we were able to utilize that and complete the deal within 14 days. So our fast track product is our bread and butter, basically. This is what we use on a day-to-day basis. It's one of our most used products and most utilized products due to the fact that they can be done so quickly and they can be guaranteed that value. This sheet is just to demonstrate how we lend nationally. When I say nationally, we don't lend in Scotland or Northern Ireland just because we don't know the market. It's slightly different from what we do in England and Wales in terms of how they do their conveyancing, etc., etc. So we don't lend in there. Or however, we do have lending partners in Scotland, and we also have brokers that refer us business from Scotland. So we do work with people in Scotland. We just don't lend on assets in Scotland. But yeah, this is just to demonstrate how we can lend nationally. We have done quite a few quirky deals up in Wales. I know someone earlier mentioned that there are a lot of holiday lets in Wales. We are coming across quite a few of those as well. But this one was to secure over a couple of flats which were going to be used as holiday lets in Wales. Another one in Salford, which was an equity release on a residential for foreign nationals. They wasn't able to come to the UK at all, so we utilised our electronic sign-in and KYCs app for them. which this one here in Colchester is my favorite one. This was a very niche property. One of them is a timber frame. The other one is a very small residential property that needed of reno, and they were being used for holiday lets. The other, also the majority of the value was taken up by a vineyard. So I didn't even know we had vineyards in this country until I came across this property. But this is what I love about property. It was really quirky. It was really fun to do, and I'm glad we did it. And yeah, these are just a couple more of our standard case studies. I'm sure you can read. But these ones we use AVM, another one mixed use in London, which was quite urgent that we needed to use a desktop valuation for. It was really hard, and a lot of us put a lot of effort into it. This was a 3-week completion from application. Another one in London. Everybody does deals in London, so they don't really bother me that much. But that was funded in 3 weeks. And then another one in Brighton, which was an auction purchase, really sort of cool looking flat and offices. We used a desktop valuation because it was mixed use, but that was completed within 13 days. So yeah, we love our fast track products in oh no, have I spoken too long? Am I the only one?
No, you've still got a minute. Carry on. No, you're fine. You're fine. Carry on. I've just you're about your 20, so you carry on.
Oh, it's because I keep stuttering and umming and ahhing.
Don't worry, it's the first time you've done one. We've all been there.
It is.
I won't tell you what I did the first time I did a presentation. So.
Oh, please do.
No, I won't.
I just wanted us to highlight a little bit more about our fast track product and some of the difficult deals that we've come across in the past. But they're all here for you guys to have a look, and if you do have a speedy deal that you need to talk to Tony about, please do talk to Tony about it, because he understands that we do work very fast. But I did want to talk to you a little bit more about our ABM processes and things like that, but I guess I can do that if I'm invited back.
Is that your last slide? Because I was going to cover that anyway a little bit on what you do. Sorry, actually development exit. Okay, go on. You go back to your AVM bit.
No, it's fine. It's fine. Go on. You can talk to me about that.
Okay. Well, I'll probably cover that anyway. Sherice, thank you very much. I know you was very nervous before that started, but
nervous.
You did well. First time I did a presentation, I was so nervous that I was standing up in front of people, and a little bit of wee came out. I was so nervous. I'm sure
I'm glad you can only see me from the waist down.
I've now done over 100 of these, so it's just like chatting with a friend in the pub, to be honest with you. So without the alcohol or the Campari. Tuscan are an unusual lender for us. I mean, the fact they've got the AVM situation is a major advantage. We all know with bridging how difficult it can be sometimes when you've got surveyors going out, the cost of the surveys, because quite often they're long-form red book valuations. So the AVM side of things is a major plus for us. Our biggest plus with Tuscan is, and I hate to say it, I'll not name drop him, but Colin Sanders, who's the CEO of Tuscan, has been a really close personal friend of mine since the late 80s.
Really?
It's very much a situation where if I refer a deal to Colin, it's normally over a drink in a pub, for example. It's not on the telephone. It's one of those sort of situations. So we do have a very close relationship with them, and with Jim as well, who's obviously on holiday at the moment.
The man, the myth, the legend.
Yeah, absolutely. So they're a lender that we can get stuff through quite simply because they want to work with us, and they know we can put a deal together. So, Sherice, thank you very much. We got one question which I think you can answer. I think you know what your answer is going to be, but I think we'll give my answer afterwards. So, Maria said, "Thank you for your questions today, by the way, Marie. So if my client is looking to buy auction at 350 grand, you will lend 297,500, and is this grossed up? GDV would be 450 to 500 after improvements."
It depends on the day one value. So if the day one value is 350 grand, then we will lend up to 75% of that. If it's if we have a lower purchase price, then we can lend up to 80% of the purchase price, not exceeding 75% of the day one value. So it just depends on what the day one value is. That doesn't include the GDV. So if the GDV is 65%, if the GDV is 450, then we can lend up to 65% in further drawdowns. So once we get that uplift in value, we'll have a better idea of where we can lend. But it would usually be, if we're doing a refurbishment loan, it will be 65% of the day one value, so 65% of the 350, and then 65% of the 400 to 500,000 pound value in drawdowns.
Marie, I haven't got a calculator with me, so I can't work out all these percentages in my head, even though I'm the son of a maths teacher. But I think on that one, if it's one that Tuscan can do, we might have a solution for that, which I'll probably be talking about in my next presentation part. So June, maybe we'll speak a little bit later. Julian has said, do you work off true day one value or purchase price?
We work off day one value, so open market value. And then we'll work, we can't exceed 85% of the purchase price. So, but we will work off day one value. OMV.
Yeah, so if the value, so Marie's just come back, if the benefit example said 85% of purchase price, if the actual market value is above the 350 that Marie has mentioned, then the figures may work. It depends on what the market value is.
85% of purchase price, but it didn't exceed 75% of open market value.
Yeah, it's all down to valuer's comments, of course, and how the value is. So, okay, I'm going to just cover one question from yours. Let me see which one, because you gave us 5. Does Tuscan Capital require personal guarantees for loan approvals?
I think I did mention that in somewhere in my
I popped out to the loo at one stage again.
Sorry, it's fine, it's absolutely fine. We don't require personal guarantees if the loan is up to 65% loan to value. If it isn't, and we do have a company borrower, we can look to just accept a personal guarantee from one of the several directors, if there are several. If there's only one, then we will require a personal guarantee if it's over 65%.
Okay, Sherice, thank you very, very much. You've broken your cherry in presenting online to people. So well done. It is a nerve-wracking thing. I know it is.
Very much.
It really is nerve-wracking, but there you go.
Thank you so much for having me.
Stay in the room. Simon will remove you from the room. Otherwise, like I said to everyone else, you could close down the entire event.
I know, yeah, and that would be me.
What I'll do is I'll put this slide on, and Simon will take you out, and then it's on to the last part of today. Again, thank you, Sherice. Right, everyone. So on to the final part of today. Again, thank you. We've had a record attendance today as well, which has been marvellous. I'm not sure the exact numbers at the moment because sometimes people flit in and out, watch a certain lender, that type of situation. But it has been record number of delegates signing up and a record attendance. So I can't thank you enough. And my marketing team and IT team have worked very, very hard on this one, on this event. It's proved to be very, very, very worthwhile so far. So just on to me, this is a little bit about us. But I always start with what's happened recently. And forgive me because I wrote much of this yesterday. So I've got to remember what order I put them in. So, but new for 2023, we've got some exclusive products from Castle Trust. You've already seen the 75% buy-to-let that Gary Maher was talking about earlier on. Cheaper rates than Shawbrook, Interbay and Hampshire Trust. Please bear that in mind. Hampshire did change their rates yesterday, but that's for stuff over £1 million, as the majority of business seems to be under £1 million. So Castle Trust 2 come out cheaper. And one thing they haven't covered is the 80% LTV net exclusive. Now, you've received details of this from us this morning for light, medium and heavy refurbishment bridging loans. So 80% net LTV. Doesn't fund any of the build costs. If you've got somebody that's just looking to get the maximum day one and then do the build costs themselves, it's a great little product. And we've proven to be very, very popular at this moment in time. Also new for 2023, Marie from West One was talking about the residential side. We are also a packager partner on their buy-to-let side. They recently brought out 100% minimum rental cover requirement on a certain number of plans. It is limited edition. They're going to see how it works, see what the quality is like. But once again, it's probably one of those, have a look through the stuff you've maybe declined recently because it didn't fit. and see. Just give us a call, and we can literally give you an answer within 60 seconds whether that deal could proceed or not. But this is proven to be very, very popular. So, of course, with being very popular, it might only have a limited tranche of funds as well. So get in quick, as quickly as you can. And the little new product launches from these lenders, Tandem, who we've recently gone on board with, you'd be aware, and we're covering actually in the next two slides, that Roger Morris, who was at Speciaist, has now joined them. So we've been invited on board as a packager for their first charge product, and they will be launching new products. And I've actually, this is the top one where it says CAP is a brand new lender that's looking to shake up things as well, come to the market with something different. I haven't actually given the whole name because I've been sworn to secrecy. So if you do try and search CAP on the internet, you're going to get stuff that doesn't apply to the lender I'm talking about, but more to be actually advised soon. It's coming up very, very soon. Just a reminder for those of you that didn't see my first presentation this morning, Sutton and the Specialist starts on the 1st of March 2023 with Roger Morris, who's the Director of Sales and Distribution at Tandem, formerly of Precise Mortgages, and I'm no doubt many of you would have seen him present when he was at Precise, because that's what he spent his time doing. He was all over the country doing presentations day in, day out, and very, very good he is at it too. And this is just a reminder of exactly what he's looking to do. And if you did miss the first part this morning and you do want to register for this show, just enter SATs in the comments. Also, my IT team have told me they've set it up so that when you get the feedback questionnaire at the end of today's show, once you've completed it and click the final button, it will then take you to a link for that to register should you so wish. But we can see that's going to be very, very popular. It already is very popular. Had lots of people sign up to that. I'm going to cover a little bit on consumer duty. I've highlighted one part in yellow because it is a concern to me and a concern to other people in the industry as well. We know consumer duty is coming. If you are an AR, you're probably not seeing too much on it, although your networks are probably panicking massively. Just a couple of things I highlighted there in red. Cross-cutting. I've still been Googling cross-cutting, and I can't see any relevance to that in what we are talking about in this particular thing, other than if you're mowing a lawn. And there's a few other descriptions of what cross-cutting could mean, but not in this. It's typical of the FCA just deciding to use a word that makes them look probably more important and intelligent than they actually are. And the 4 outcomes part, where the consumers receive communications they can understand. Well, we certainly don't. But the part that I've actually highlighted, and for those of you who've seen me before, you know I'm not a big fan of the FCA. I'm really not. But the fact that brokers need to offer fair value. Now, having spoken to some people in the know, this could potentially be the FCA's start of trying to ban commission. I hate to say it, but this could be the start. If they do, it's probably the end of a good part of the market as we know it. But hopefully, with one of the slides that's coming up in a moment, that will never actually happen, which I think is 2 slides away. So hopefully that will alleviate any concerns you might have. But they've done it in other aspects of financial services, and they hate the words commission. Secret commission, I've heard them call it bribes before. But that's what we're up against, unfortunately. If you are an appointed representative, you probably know all the problems that your networks are going through at the moment. That's just some of the stuff. The final bit that has to be submitted by the 28th of Feb, which is a data request, a Section 165 data request. I couldn't tell you what that is because we don't have any ARs. But we are already seeing, we're getting a large number of people who've been part of networks, and they're not the big producers. They're the ones that make a decent living from what they do, but they're being culled. They're being cut off for whatever reason and being left out in the wilderness. They're then trying to find a new home. Depending on what type of business they're in, we can possibly help you. Contact me personally if that's something you'd like more information on. But expect some ARs to leave the industry for good. I did see something on one of the news outlets the other day that there's now the proportion of people that are operating in financial services who are not regulated by the FCA has shot up 6-fold. I wonder why. Because the FCA keep coming out with ridiculous ideas that they really don't know what they're doing. But luckily, this has also happened at the moment. This was from Friday. Staff anger reaching tipping point at the Financial Conduct Authority, with half considering leaving. But if they do, hopefully it's the good half that's left, because my experience whenever I phone them is sometimes quite appalling. And no doubt what they'll do if they do have people leave, they'll just take people out of their complaints department to cover other aspects of the business. There'll be nobody dealing with complaints about the FCA, just like they did during COVID. But serious recruitment challenges as well. So I really don't know. What I did like was that the union, I think it was Unite, sent the CEO of the FCA a Dear CEO letter, which the FCA love to do when they send letters out to lenders and brokers sometimes, they're addressed Dear CEO, so taking the mick a little bit. So a little bit of information about us, what we can do for you. This is very much for those of you that have never watched one of these presentations before, never used us before, that type of thing. For those of you that have, you've probably seen this a few times in the past. There is some new information in this, but you've seen some of it in the past. I have cut it down a bit, and I've made myself one promise for 2023, which I'll come on to in a moment, that I'm not going to be so bitchy about certain people in the market. But first of all, starting off is to give you a little bit of comfort that we do know what we're talking about. We've had 3 compliance visits now. Unfortunately, the third one, they only gave it to us verbally, so which is a bit... So I can't really write something down as to what they said about us. But again, it was absolutely A1. They wanted to change one thing on our website, which was so minor, it was unbelievable. But this was one from 2017 when they first started doing their compliance reviews. And we were told we were the best in the market by a country mile of NACFB members. And I do not see as what you do is moving the goalpost, more a case of better than best practice, particularly considering the resources you have available. And that's at a time when, as a company, we probably had less staff than some of my competitors' compliance departments. So it's something we take seriously, something we do very well. It normally is just common sense, to be quite honest with you. But it's something we do take incredibly seriously. And this was from 2020, just before COVID, identified no gaps in compliance and regulation and identified areas of best practice, notably in AML and data protection controls. Third one, exactly the same. So we do know what we're talking about because we've been doing it a long time. What we offer you is a partnership, because I hate the word. I mean, Marie used the term master broker earlier on. I hate that term only because it gives away the impression that we are better than you. We are the masters, and maybe you're the little serfs, sort of like that we look down upon. That's certainly not the case with us. I mean, we see it as a partnership. We call our introducers broker partners because that's what they are, and we want to help you grow your business. It doesn't matter what your FCA status is. We have solutions. If you're not authorised, there is now certain restrictions on what we can take from you for obvious reasons. Our PI cover won't cover certain aspects of what you introduce to us unless it's done in a certain format. And we want to make sure you stay informed and stay compliant indefinitely, because one of the biggest problems I had in 2009, it wasn't just the lack of lenders in the market. I had so many of my broker partners going out of business or just deciding I've had enough of this. I'm going from the market like completely, sometimes because they hadn't prepared for it. This is something with this, what we're going through this year, which thankfully we're now told on the news a couple of days ago isn't going to be a recession this year, after being told in October it was going to be a serious depression and it was going to be absolute carnage out there. We're now, the latest news is that we should probably, I think the word they use was swerve. What was expected. And so just goes to show that none of these people, these experts, have a crystal ball and can predict what's going to happen in the future. But we want to make sure you're still around. That's why we issue GDPR checklists. That's why we do all these things to make sure that you're going to be compliant and also informed as well about what's going on in the market. So our products, everything pretty much other than equity release, that's not something we've gone into. I have no plans to do that. But everything else that you see there is something that I would say we have a large level of expertise in, a massive level of expertise in all of those aspects. And it doesn't matter how you want to place business with us. We can either package on your behalf, and we now package for 9 lenders, soon to be 10, or introduced only. So if it's a case that you just wish to pass it over and let us get on with it, which probably 70% of our cases, that is how it is, because of the feedback that our broker partners see after giving cases over to us, they're quite comfortable with doing basically just, here's a name and telephone number, more often than not is all we're given, and we just crack on with it. And that's the way it works so well. But if you want a package, if you want to make sure you keep the client contact, as long as you've got the permissions, more than happy to do that. A little bit about why we're different. It's not the products we offer, because we offer pretty much, other than the odd exclusive that we offer pretty much the same as everybody else. It is quite simply the people we employ. Now, we all know how important it is that when you employ somebody and they're dealing with other business professionals like yourself, that they've got to know what they're talking about. First of all, that is absolutely vital. So I insist that anyone coming to me for a job has a minimum of 5 years financial services experience. But the most important one is mature life experience, because you don't want to be speaking to somebody who's been in the market since they were 16, is now 21, and really still talks in tech speak. That's not what you're after. You want those people that got that life experience that you can actually have a conversation with. And on the rare occasion something does go wrong, my staff are that experienced that they actually recognise it, because we're not perfect. No one is. But when it does go wrong, we recognise it early and we have the experience to deal with it. That's why we've not had any complaints whatsoever in years, other than about lender service levels. That's the only complaint we ever received from a client. Why is the lender taking so long? That is it. And the reason is that because I employ people that are mature life experience, who've got kids, they've been in the business. I've got 2 members of staff that have been in the business since the mid-90s in the specialist finance side of things. It pays dividends because I'm not having to look over their shoulder the whole time, make sure that actually they know what they're talking about. They do know what they're talking about. And the other reason why we're different are lender relationships. You might have gathered so far that because I've been doing this for so long, a lot of my contacts are at director level. So, for example, with Tuscan, if I want to discuss a deal, I'll ring my friend Colin. He's a CEO. He's the one who makes the decisions, rather than my team will go through the underwriters and our BDM, but I will speak with Colin. And it's the same with so many of our other lenders, that when we have cases that are slightly borderline, I'll pick up the phone, speak to them, and place it in such a way that they know that it makes sense, or they will hopefully know it makes sense. We don't get every deal through. Of course we don't. Some deals are just not placeable. But our lender relationships is a massive, massive plus for us, and the amount of business we can get through. And because I'm so close to the ground as far as the cases are concerned, I'm not sort of like sitting in my ivory tower just looking down on my staff, crunching numbers and counting completions. I'm actually actively involved in the day-to-day running of the business, but also the day-to-day what cases are going through and helping cases through. We take our compliance and prevention of financial crime very seriously. And this is the promise I've made to myself, is it's not our numerous awards from the financial press. I have a huge dislike of the broker awards regime in the UK. I think it's corrupt, and that is all you're going to hear from me. There's no more slides on it. If you want to go to brokers who won 87 awards, if you knew the reason they got some of those awards, you probably would never give them another deal again. And I have seen grown men crying in toilets because they've not won the best bridging broker award. Certain awards do. That's not really where I want to be. I'm too old, to be honest with you, to bother about things like that. If they want to one day present me with an old git service to the industry award, I doubt very much if they would do, because I'm very vocal about my thoughts on awards over the years. I might accept it, but you never see me go for an award for best broker or anything else. It will never ever happen. That's my last on it. What else? We offer designated underwriters from start to finish. You don't want to be dealing with a sales department, an underwriting department, a completions department. It doesn't work, unfortunately. So my team pick up the cases right from the start. They then have full knowledge of the case throughout. They know exactly what needs to be done, and that's from pre-offer to completion. The only time I get involved in a case is if there's a problem or when we pay your commission, because it is paid immediately upon loan completion, as long as we've got your correct bank details. We do occasion, we've had one recently where we were given bank details, the right name, right sort code, but the right sort code, right account number, but the wrong account name. HSBC wouldn't accept it unless I tick disclaimers saying, tough, now that could have been the wrong account. So but we finally got the right account name and now it's gone through. No commission clawbacks unless it turns out to be fraud, or unless the client cancels the contract within the first 14 days, which sometimes they're allowed to do. But other than that, we don't claw back commission. And the other thing, this is a real plus, because we're involved in the second charge market, it means that we can get Equifax or Experian searches on day one in-house, not the client's version, the lender's version. It's what the lender wants to see. And it means we pre-qualify. As long as we've got the client's permission, which we can gather in various ways, we will get that search done straight away. It means we go down the right road straight away more than anything else. We're not hitting that cul-de-sac because we weren't aware the client had a, worst case I saw was a £12 million CCJ that he didn't tell us about, he'd forgotten about 3 months previously. We're immediately going down the right road. And that is so important. I hate wasting time. My staff hate wasting time approaching lenders when it didn't fit for that lender in the first place. And something else we offer, this is something we designed ourselves, wasn't happy with the sourcing systems. I would never extend this to regulated first charge mortgages because there's just too many products out there, or mainstream buy-to-lets. But what we came up with, these are all different aspects of, so loan quote covers the second charge side of our business, commercial quote covers all the commercial lenders, and the buy-to-let lenders you don't see on the sourcing systems. You don't see them on Trigold, Mortgage Brain or 27 Tech because they don't subscribe to them. And we also have Bridge Quote, which is quite simply every lender on our panel, which currently sits at about 28, I believe, looking to maybe add and take off a couple. But we've come up with our own systems, and we can quite literally, when you give us a call, we can come up with quotes in seconds. I had a client phone me yesterday and using our commercial quote, go through about 8 or 9 different scenarios, and the call took 7 minutes, literally 7 minutes. And he's now gone away. He knows exactly what he needs to do, and that's why he uses us, because we can come up with those sort of help him to make the informed decisions that he needs to do what he does. And he's been very, very successful from it. Second charge panel. I'm not going to go for every lender, but as you can see, it is extensive. It's everybody in the marketplace, as you would expect from, I hate to say master broker, but it's a professional second charge outfit. It's one of the biggest parts of our business, and we deal with literally everybody. All of these lenders appear on our sourcing system. These would not, most of these probably would not appear on the 27 techs and the like. And if you do put your business through L&G or Simply Biz, this is what you're up against. Now, this was taken yesterday from the L&G Mortgage Club second charge panel. Masthaven stopped lending in February 2022, and Speciaist finally pulled their products in August 2022, but the products they had up for about 2 years prior to that were not worth offering. So if you go for L&G Mortgage Club, Shawbrook and UTB, that's your choice. Simply Biz is slightly better in that they've got Central Trust as well, but for some reason they've still got Paragon showing. Paragon stopped lending in 2021 on second charges. So you can see how much is actually going into this from those particular mortgage clubs. They're just there just to collect whatever they can. They don't know, if you phone them on a second charge, they really don't know the criteria, but they've only got 3 to learn anyway. But that's what you're up against. We use Simply Biz and L&G for first mortgage business because we have to. If you use them for second charges, it's an add-on that's never really been used by them. I've never been set up properly. So if you want to advise on second charges, though, this is how you can do it. We can help you navigate in what is still a complex market. We've got access to every lender, as I mentioned. We can help you source the best product, first of all, for your client's needs. It does take literally, probably for a second charge, it takes about 90 seconds. Help you with your file compliance. Instruct the surveys, issue consent requests if the first mortgagee has a restriction at land registry, package a case on your behalf, check all the documentation, pay you the income on the day of loan completion, no loss of control, and we don't charge a packager fee. Wow. And we also, on some deals, we pay away part of the prop fee. Well, most deals now, we pay away part of the prop fee over a certain loan size. So you can charge whatever fee you want. If you want to charge $495 because that's your business model, you can do. If you want to charge $5,000, as one broker that we have does, you can do. It's entirely up to you. We don't take a penny of it. So that's what it's there for. It's not available for first charge mortgages via the high street. Please don't this afternoon send us over deals for the Halifax you've had sitting on your desk because they're $30,000 and you can't be bothered to do it. We won't touch those. This is for second charges only on this particular product. Although we will package obviously on other bits. So first charge panel, family building site, the main ones you'll see there, family building society, Speciaist, together, Tandem, we can package on your behalf and complete business, except for Tandem because it's only just launched, completing business with all of those. The others are just the minor lenders we have that pick up some business that is something more niche business that you might not be able to place elsewhere. So that's our regulated first charge panel. Specialist buy-to-let panel where we give the advice. I could probably do 3 slides on this because, of course, we've got the likes of BM Solutions and others that you've got access to if you're involved in the buy-to-let market. But that's basically everybody that you could probably think of that's in the specialist side of things. And if you want to give the advice, these lenders are what we can offer you now. All these lenders, and I need to actually no, I don't need to add Tandem yet because they've not launched their buy-to-let product yet. That's next month. All of those lenders, we can offer you a packaged service, and if it's one of these lenders, we would not charge you. We would not charge any packager fees whatsoever. Now, to compare that, if you are using packages at the moment, just to compare that, and I want to make sure it is the next slide, you could be going 3MC. They'll charge £95 up front, all the way up to TBMC. No idea what these things stand for. 299 quid. That's going to cost your client. We don't charge a penny for those lenders. The reason why? Because we're set up to do it in such a way that it doesn't take up too much of our time. It is not a great effort for us to get a decision on a case. So if you're using others, give us a try. It's cheaper for your client straight away. And it can't be beaten. It really can't be beaten on price. And I'd say it probably can't be beaten on service either. Bridge and lender panel. I mentioned earlier on it's about 28. I don't know if there's 28 on there, but that's everybody. Now, most of those lenders, we have packager status. That means we all earn double what you would get if you went directly. So, of course, if you decide you want to package the deal yourself, you want to give the advice yourself and we package it, then we can pay you what you get if you went direct. But you've got our expertise and our know-how and our contacts and everything else that means you can get that deal through that might be borderline, or just get that deal through quicker. And our commercial panel, everyone you see on there, very much the same again, advised or non-advised basis. We try and steer clear of like packaging for the likes of Barclays, NatWest and Lloyds, because there's not a great deal of money in those deals most of the time. But for a lot of those lenders, they are paying us decent prop fees, and therefore it's worth our while in doing that. And certainly last year, we saw a number of our broker partners earning significant amounts of money on commercial business, purely because they then had an outlet for it, because it's something they might not know or something they might not have access to a lender. One of those lenders might not have given them an agency. They now got access to it and they can give the advice themselves, and we package. Your commission and prop fees, we've come up with our own booklet, which looks very much like that. If you just enter the word proc in the type your message, we'll get that out to you. It changes on a regular basis for obvious reasons. And once you've downloaded it once, we'll send it to you once, we know you're on the list. We'll send it to you once it updates. But that will come over to you. It's pretty much everyone we deal with. It's not every lender in the marketplace, as you can imagine. Otherwise, it'd be a nightmare to keep updated. But it tells you exactly what we earn, what we'll pay you, and how we pay you. But always remember, we pay you on the day of loan completion. This isn't a Simply Biz where you might get the money 6 weeks later sometimes, or an L&G, sometimes even longer. We pay you on the day of loan completion. We've got your bank details, of course. Beware of the bandits. The broker on this is actually going to be attending for the first time next month. He signed up for next month's show, so I need to make sure I'm okay to say this. But he completed a case, or he put this with a master broker in 2019, and for a lord and lady, one of his clients, and it was a £7 million case. He was told that the prop fee from the lender was £14,000, and he was paid £7. When he came to me after falling out with said master broker, and we mentioned the deal, and I said, "How much were you paid?" And he told me, I said, "This is what that person, I don't want to say he or she, this is what that person actually earned. That company actually earned was £117,000 from that deal, and paid away £7. Just be careful who you deal with sometimes, because there's still some crooks out there. There really is. A couple of case studies. I'll flick through these. I have handpicked these because they give you an idea of the sort of things we can get through. This one was a 10-bed HMO or 20-bed property being used as a 10-bed HMO. In reality, it was actually being used illegally as a 20-bed HMO, very near to Heathrow. You can read through that. Introducer got 21 grand on completion. That was all the way back in November 21. The reason it's still on there, in October 22, the client still hadn't been able to get some of the planning issues sorted, so it came back to us. We approached Roma, got it done again, rewrote it, didn't charge the client any fees. That time we paid the broker partner 25 grand. And we're now arranging the exit with a lender that we will know will take a 20-bed HMO. And it's already been pre-approved, subject to the final planning issues being sorted. So far, broker partners earned 46 grand off that one deal, off that one client, and more to come down the line. And again, we didn't rip the client off by charging fees. We only received what we were due from the lender. Case studies. This is, as it says in the penultimate sentence, by far the most difficult case I've ever had to deal with. And I've been doing this now almost 40 years. Borrowers were a very wealthy 82-year-old expat and his eldest son living in Israel since 2001, 19 properties being refinanced, including 2 with regulated tenants. If you know what a regulated tenant is, you know how difficult it is to raise finance for those. And we were raising 6.4 million. 5 properties. The clients had a solicitor who had basically been ripping them off for years and hadn't done most of the work that he was supposed to, including removing mortgages that were repaid in 2000. One of them was repaid in 2003. His job was set to remove the charge. He didn't bother. There was one of the flats that they bought. The lease hadn't been registered at Land Registry. It was every single issue you can think of in a case came up, and we were dealing with a solicitor that really was not fit for purpose. So we managed to not only get dual representation. So we had the lender solicitor, who is a very close personal friend of mine, dealing with it for both the client side and the lender side. So we got rid of the old solicitor. But we also managed to basically, and then when there's ASTs in the wrong name, ASTs could not be located, properties that weren't insured. It was an absolute horror show. Absolute horror show. Introduce a partner who literally, and this was a name and telephone number, 45 grand on the day of completion, £45,000. Okay, this is what he said. If I could give you more than 5 stars, I would. And I won't read the rest of it, but basically, in a nutshell, what he said about us is that he was retired. He just decided to come back into it because so many of his clients were phoning him and saying, I need finance, what should I do? So what he now does, he just literally refers them over to us. He's now classed himself as semi-retired. He's earning more money now than he did when he was active by putting it through, it's all coming through us. And he's absolutely over the moon. He just says he's never come across a set of staff so professional, so likable, so easy to deal with, who know exactly what they're talking about. They never get flustered, phased by a question. They can answer every question. The only time he ever calls me is to tell me how wonderful they are, which is very, very frequently. So as you can see, I've got one very, very happy, now out of retirement, very experienced, in his 70s, ex-mortgage broker, earning decent money. Another case study, this was borrowers aged 86, 82. I mentioned this when Gary was talking from Castle Trust. We did this with Castle Trust, refinance of 18 properties all in the same village, 7.9 million. Some had no EPCs. Almost all were under-rented, massively under-rented, because they were one of the largest employers in the village. They didn't want to upset their tenants too much by raising their rent. So some of the rents have been in place for years. And they'd also been defrauded of significant sums of money. You're talking in one case, 8 million quid with one fraudster. They didn't trust anybody at all. So second most difficult case I've ever dealt with, introduced a partner who is appearing next month, or is a delegate next month, 30 grand on the day of completion. Took me out for a very, very nice slap-up lunch just before Christmas, all on him, to the best restaurant in Berkhamsted. So that was for which I was very grateful. And of course, put it in the register, the FCA register of things we've received. And it's not what you know, it's who you know. Can't stress this enough. This is the best example I can give you, quite simply, of why it's all about contacts in this business sometimes. For the cases, not for the vanilla stuff, because we can all get that through. But for the cases you think, what am I going to do with this? Husband and wife running 2 very profitable children nurseries. Wife ran the looking after the kids side. Husband did all the financial side. He defrauded HMRC out of 850 grand over the course of quite a few years. It was only when one of the staff made a query to HMRC and they said, well, you haven't paid any tax and national insurance for 15 years, that they realised there was an issue. She found out, divorced him. She started divorce proceedings straight away. Mr. ended up in court and was sentenced to 5 years in prison. Proceeds of Crime Act charge put on every single property that was owned, had his name on. Try remortgaging anything with a Proceeds of Crime Act charge, because I put it in red. Reputational risk is what you'll get back every single time. Lenders do not like it. So what did we do? Quite simply, came to us. My staff did their usual. They contacted the underwriters, who took it to compliance departments, and every compliance department said no, including Together Money. Case given to me to sign off as a decline. I thought, no, there's a deal here to be done. 10-minute conversation with a director who, again, I've known since the 80s, good friend of mine, and gave him an overview of the case and the background, exactly what had happened. You can, why wouldn't we do that? Well, quite simply, your compliance department said you won't. There's a difference when an underwriter goes to a compliance department than when a director goes to a compliance department, believe me, because, of course, he's gone round there, shouting, why aren't we doing this? And they're all like looking at him, cowering, thinking, oh, Christ, number 2 in the company's about to go crazy on us. And he's come back to me and said, yeah, we'll do that. No problem at all. Did the whole lot. She kept her businesses. She kept her house. She kept both her buy-to-lets. Husband came off everything because he was still in prison, or ex-husband by that stage was still in prison. It saved her business. It saved her home, saved everything she had, every asset she had, introduced her in 12 grand. I've taken out the slide of what the testimonial he gave us, but it was absolutely glowing. It really was. He mentioned a world-class service several times in it. But that's what a best case I know of. It's not what you know, it's who you know, because you can get cases through. Because underwriters will only say criteria says no. Quite simply, people at the top want to write business. That's what pays the wages. If they think that someone's going to pay them back, the client's going to pay them back, they will try to find ways to do the deal. Right, so cases you can't place, we are coming to the end. You'll be glad to hear. Cases you can't place, leave your name in the type your message box below. With details of an inquiry, we'll call you back straight away. You complete a decision in principle form that we will be sending to you. You might have already received it actually, because there is one for every product. Go to our website. You can see there. Alternatively, give the team a call, go old school and actually have a conversation, and we can tell you what's available. Follow me on LinkedIn if you would. You probably will receive or have received a request from me on LinkedIn, but please follow me on LinkedIn because it gives you details. When we launch products, we put them on LinkedIn, so you'll see them hopefully, as long as you haven't got 5,000, following 5,000 people like I am. I mean, you don't see, it's like being on Twitter and you don't see, unless the timing is right, you don't see anything. But that's where we announce a lot of what's going on. Of course, you can always follow Specialist Financial Services on LinkedIn as well, and you'll get updates on that as well. But you will receive a request from me if you haven't. If you've got a name like John Smith, it's unlikely we'll find you. Please send a request to me. If you like what you've seen today and you want to start placing business with us, we will need one of these back before we pay you any money. That will be sent to you with the introducer pack that's going out to you today. Just get it back to us. If you already signed one of those, you don't need to sign another one. I've got some broker partners who sent me 8 or 9 of these over the years. You don't need to. You just need to sign one. We'll only send you a new one if we need to change the terms. Next Specialist Mortgage Web Show is on the 9th of March, where we have speakers from Interbay Commercial who will be talking, I would presume, about commercial. Yeah, they will be talking about commercial. Hope Capital will be talking about bridging. Lenco, the best lender you've never heard of, is my description of them. We'll be talking about buy-to-lets. And Selena Finance with their unique drawdown second charge product. Well worth a listen and a watch. So please attend. You can sign up for as many of our shows as you like. This is our schedule for the rest of the year. Very, very busy. As you can see, we normally do the first Thursday of every month. We've had to change it because of so many bank holidays this year. We've had to move things around a little bit and buy holidays and other bits and pieces. So you can register for as many of these as you like. Feedback and CPD. So as I said before, this is very important if you want to get the feedback and then the other links and then the bits for the CPD certificate. When you leave today's session, click the event board in the top right corner, then the red exit event box. Complete your feedback form. You'll get a link to the Sutton and the Specialist registration should you want it, and your CPD certificate will be emailed to you shortly. Don't enter your, I need to take that out. Don't enter your name in the message box below. There's no point. But just that will be emailed to you. That will come over automatically. If you haven't got it by tomorrow lunchtime, let us know, because head of IT is off next week, and I don't want a load of CPD. Well, I wouldn't have a clue how to do it because it's all done through IT now. Help us out. Hopefully you've enjoyed today enough to go on Google or Trustpilot and leave us a review. Please don't go to Specialists Hub, which is a separate training company who set up about 2 years ago during COVID. I'm not sure if they're still actually trading now, but if you want to leave us a review, that'd be absolutely fantastic. Again, a big thank you to today's sponsor, Castle Trust Bank. And finally, last slide, I believe. Thank you for attending. Enjoy the rest of your day. Until next month, stay safe, sane, and prosperous, if you can stay sane in this market. And we look forward to seeing you again. Thank you very much.